Dear students, thank you for watching this video tutorial on Venkman problem. It's the first problem of the course in which we will be learning how we are dealing with the transaction, how we record them in our T accounts, how we prepare the trial balance, and afterwards how we use the trial balance to prepare all three financial income statements. So let's start. So here you have all transactions given, there are 5 of them, and we know about the company that it was founded in January 2016, and we need to prepare the information and the financial statements on the 3 months ended on the 31st March 2016. So we'll be dealing with the information, we'll be dealing with the transaction for the 3 months, and afterwards we will be preparing the income statement, statement of stockholders' equity for these 3 months. Balance sheet we will prepare on March 31st, and then we will see which type of the cash flow we will be preparing today. So once again, just to recap of everything we will be doing in this video tutorial, is that first of all we will prepare the journal entries and general ledger, then trial balance, and the last step will be to build the financial statements. But before we start, I would like to do the quick recap and the distinction between the par value and the market value, as we not yet looked into details and carefully on the statement of stockholders' equity and the elements of stockholders' equity. You need to understand and distinct clearly between the market value and the par value, because you always will be given by the transaction these two values. So the par value is an arbitrary amount assigned to each share of stock when it's authorized. So it's the minimum amount that the company assumes that the share costs. So it's, in other words, it's an internal value of the share inside of the company. So only the company and insiders of the company know the real share of the par value. Par value remains constant, it doesn't change, and it's really normally small amount, like $5, $10, or even 50 cents. So it's the inside value of the shares which the company assigned to their shares, just to nominate them. While the market price is the price which appears on the market, which is constantly fluctuates according to the economic conditions on the market, and which is visible to the buyers, which is visible to the competitors, and the market price which is appear on the public financial markets. Once again, is not the company who is usually assigned the market price. It's fluctuated and it's based on the market conditions, and is amount that each share of stock will sell for in the market. And normally the difference between the market price and the par value, they are significantly different. As market price and par value, the difference between of them, if the market price exceeds the par value, it gives us additional paid-in capital. So let's look on the example. So for example, on September 1st, Matrix issued 100,000 shares of $2 par value. So $2 is how much Matrix value, real value of their shares inside of the company, for how much it cost for them, and for $25 per share. $25, it's a market value for which the shares will be sold on the market, to which it will be sold to the sellers on the public market. So how it will be recorded? It will be recorded cash. We always record at the number of shares times the market price. So 100,000 shares times $25, it gives us how much cash we received. Then the common stock is a golden rule in financial accounting, that the golden rule will always record at the par value, the par value of $2. And we record it as we are taking the number of shares total issued times $2, the par value. And then additional capital is the difference between the first number, cash, and the common stock. Here is the principle, here is the golden rule, how we record this type of transactions. Let's move forward, and now we're starting already dealing with the transaction of our Venkman problem, and we're starting with the first one. On January 1st, the 3 owners each invested $40,000. So it means if we have 3, the total amount of money invested was $120. for which each received 30,000 shares. If each received it, it means that 30,000 times 3, it was 90,000 shares issued. Add $1 of par value stock. So how we will record it? Let's record it in the journal. So the transaction happened on the 1st of January 2016. And here we'll record the accounts that we will need: debit and credit. So which account will be debit? Which account is increasing? The first account increasing is a cash. Cash is our current asset, which increasing. And by how much it's increasing, as we already told before, there were three owners, each invested $40,000. 3 times 40,000, it gives us $120. $120, and here once again I'm explaining where we took this $120 times 3 owners. So what else we have? The transaction happened on the 1st of January. So part of them we need to credit our common stock. Common stock, for which amount we should credit it. We already discussed and mentioned that common stock will always report at the par value. What is our par value? Our par value is $1. How many shares we issued? We issued 30,000 shares times 3. So it means that we'll record the common stock for $90,000. Once again, I'm explaining here. 30,000 shares multiplied by 3 owners and multiplied by $1 of par value, what gives us the common stock. And as we can see, the cash that we received for the shares and the common stock that we put, there differs. It means that in this case we will have the additional paid in capital because we actually earned money. We issued less shares, but our value of the shares appears in the higher amount of 40,000 per each. In this case, it means that we will have additional paid in capital because the value of the common stock, it's not the same that appears in our cash we invested. Paid in capital. It's a stakeholders equity account. We increasing it, and for how much? We increasing it for 30,000. Why 30,000? Because it's a difference between our cash balance 120,000 and common stock balance 90,000. 30,000. So here is our first transaction. Let's represent the same transaction but in the T account. So what happened? In our cash account, so here I already prepared the all accounts we will be using in this problem. So in our cash account we increased it by 120 and I debited. So I put it on the debit side, so on the plus side for the cash asset account. What else happened? We also have our common stock increased, so we credited because it's a right side account of equation of our accounting equation. So if we increase it, we credit it, so by 90,000. And then we have additional paid in capital, which we also credit by 30,000. Remember that our main rule that we always need to remember, that we always need to check for, is that our accounting equation has to remain in balance. So our right side equation, so it's a red one, we increasing by 120,000. So one side of our left side of our accounting equation is increased by 120. And we ensured that the left side of our accounting equation, which is green accounts, also increased by the same amount. It's a 90,000 plus 30, what gives us 120. So we ensure that our accounting equation remains in balance. Let's move forward to the second transaction. On the second transaction, on January 2, the firm borrowed an additional 100,000 from the bank. The loan is due in 2 years. So let's look how we will represent it in our journal. So the transaction happened on the 2nd January 2016. And how we record it. So when we took the loan from the bank, we received the cash. So we received the cash, our cash account is increased. So we increase it by how much? By the amount we took from the bank. So it's $100,000. Then apart from that, if we increase the cash, we need to do something on our second side of the equation, meaning our liabilities. What is our liabilities? It's a loan payable. We credit loan payable, we increase it. So we credited loan payable because we will need to repay it in 2 years. If we're repaying it in 2 years, it means that it's not non-current liability for us, because all liabilities that is due more than in 1 year, they are non-current, and we record it as a non-current liability because it's due in 2 years. If it will be due in 1 year, then we will record it as a current liability. And here also we record on the credit side the same amount. So we can see that our debit and credit is in balance. Let's represent the same in our T account. How will we represent? So for the cash, we know that increased by 100,000. Then we also have long-term loan taken. So we credit it, we increase our liability by 100,000. And we can see now that our equation is again in balance because we increase the red side of equation by 100 and the green side of equation by 100,000 as well. So everything in balance. We shouldn't worry about this. The third transaction happening, that is on January 1st, the firm purchased an equipment for $40,000 in cash. So how will we record it? So we know the transaction happened there again on the January 1st. So we recorded on January 1st, we bought an equipment. So we debit our equipment. It's an asset account. We increase our asset account. And when we're talking about the equipment, cars, houses, it's considered to be non-current asset because we are going to use it for more than 1 year. When we're using for more than 1 year, we debit our asset account of equipment for 40,000. And if we debited our red side of equation, we need to do some to balance it. So here we bought our equipment for cash. We used our cash. It means that our cash went down, so we credit our cash. Cash is going current assets minus. We credit our cash because we took this money, we used this money to buy an equipment. Let's represent how it will look like in our T account. In T accounts, it will look as following. So we credit our cash for 40,000 because we used it, and we debit our equipment. So what's happening here? The boss reports happening on the right side of our equation. So it means that we decreased cash and we increased equipment. So everything happened with an asset account. So in the add, it's in balance because in the first we minus cash, then we plus an equipment plus minus 40,000. It gives us 0 and ensures us that our accounting equation remains in balance because both transactions happen with an asset account and we balanced it. Let's move to the next one. Consulting fees earned for the 3-month period totaled 125,000, of which 70,000 had not yet been collected in cash. So let's see what's happening here. So here the company earned the revenue. Why we are already talking about the earned? So here we need to remember about the revenue recognition principle. If we already are allowed to record our revenue. Here it's said that we already earned. It means that we already provided our consulting services and we earned the money. The total revenue earned is 125. But the client didn't pay us the whole amount. It means that the client still owes us. It still owes us the difference between 125 and $70,000. So it means that only $70,000 can be for now reported in cash, and the rest, the difference, we will put in the account receivable. Why? Because we're expecting the customer to pay the resting amount as soon. So let's see how the transaction will look like in our journal. So it happens, we don't know the exact dates when it happens, so let's assume that it's first quarter dates. Because it's happening in the first quarter of the year, from January till March, and then we record it as a following. So what we are doing, we first debit our cash, we increase our cash because the part of our revenue we already received in cash. How much we receive? We know that the total amount of revenue is 1,250 minus 70,000 that we already didn't receive 70,000. So how much it gives us? It gives us $55,000 that we received in cash. So here we can increase it by $55,000. Then what we have further? We have accounts receivable. Accounts receivable is exactly the amount for which we didn't receive yet from our customer, the amount that we are still waiting. So what we are doing here, we debit our accounts receivable by the amount of 70,000 that the client still owes us, that we are still didn't receive from the client. And then we need to record that we earned our revenue. We earned already, we provided the services, so we record our revenue, so it's a consulting revenue. We credit it because it's a green account, so it's a revenue plus our revenue is increased, and as we remember, if our revenue is increasing, it means that our net income is increasing, and consequently our retained earnings will be increased as well. So what in the end gives us the increased stakeholders' equity. So these accounts in brackets you always need to specify in this way when you're talking about the revenue. So it's not only revenues which is increasing, but also stakeholders' equity. And here we already put the total amount of the transaction of 125,000. Let's see how we represent this transaction in our T account. So here we are putting the consulting fees. We earned these revenues, so we are increasing our revenue account by 125,000. What's happening further? We know that already out of this amount earned, we received from our customer 55,000. What was already paid, but the rest amount which is left, still not paid, and we are waiting the client to pay it, is 70,000. So it's how our T account should look like for this transaction. And now let's move to the last transaction happening in the Venkman problem. Is operating expenses amount to 132,000, of which 30,000 had not been paid in cash as of March 31st, 2016. So it means that we used the expenses for 132, but the part of it is still not paid yet. So let's see how we'll report it in our account. So again, don't have the exact date when this happened, so we assume that it's still the first quarter dates when it's happening. So let's do the following. So first quarter days. So we debit our operating expenses. So it's expense account plus is going up, and as soon as expense accounting is going up, it means that our net income will go down, and if our net income is going down, our stakeholders' equity consequently going down, because net income connected to the retained earnings, and retained earnings is a part of stakeholders' equity account. So let me just format it for your convenience. And we increase it by 32,000, the total amount of operating expenses. Then we know that the part of it we already paid in cash. So we took our cash and we paid it with cash. So we decreased our cash by the amount we already paid. So current assets minus for how much. We know that 30,000 is still not paid. It means that 102,000 were already paid. So here I will just duplicate the solution once again. And it gives us that the cash was already paid for 102,000. Here we debit cash for 102,000. And it means that we still 30,000 to pay for our expenses. So it means that we credit our liability account, which is called accounts payable. It's everything what we have to pay, what is our liability. And it's current liability because we need to pay this expense within the next 1 year, no longer. And we credit it by 30,000. So here is how our old journal entry looks like, and also let's record the last transaction and the T account. So we know that our total operating expenses was increased by 132,000. 102,000 were already paid, and accounts payable we still have 30,000 to pay. So here is how our transaction and report in the T accounts look for the last transaction. And on this slide we have the recap of all transaction happens and how our T accounts look after the old transaction happened, and now we need to calculate the ending balance for each account. How we are doing it? So we are basically taking everything what is we have on the debit side, so it's a plus side, and we minus everything what we have on the credit side of the red account. So we plus all these three numbers, 120 plus 100 plus 55,000, and then minus 40,000 minus 102,000. And all this calculation should give us 133,000. The same thing we're doing for all red accounts. So here we only have on debit side 70,000, so ending balance for us is 70,000. For the equipment, the same thing, there is no calculation, we have only one number of 40,000. Then, for accounts payable, our ending balance also on the debit side of 30,000. Long-term loan, no calculations here, so 100,000. Common stock ending balance is as well 90,000, no calculations here involved. And the same as for the additional paid-in capital. So here we are working with a more or less base problem with not many transactions involved. And basically here you just will need to calculate the ending balance of the account for the cash. For the rest, it was already the final numbers. And the same here for the consulting fees. So we don't need to have any calculation. So as soon as we have and calculated the ending balance for each of our accounts, we can easily prepare now the trial balance that we will be using afterwards for the preparation of our financial statements. So how our trial balance will look like? So let's start with the first account, cash. So how much we have in cash? We have in cash 133,000, and it's on debit side. So let's record it. Then the second account we'll be talking about is accounts receivable. Accounts receivable. What we have in accounts receivable, our ending balance in accounts receivable is 70,000, and it's also the debit side. 70,000. What else? We have an equipment also we have on the debit side of 40,000. So let's equipment debit side of 40,000. And the next one is liabilities, accounts payable. We have it on the credit side for 30,000, because you remember that for the liabilities plus side is the credit side. So accounts payable. Accounts payable. And it's credit side of 30,000. What else? We have a long-term loan. What is also on the credit side? The long-term loan is equal to the 100,000. Apart from that, we have a common stock, also the green account, plus on the credit side for the 90,000. Credit side of the 90,000. Next, we have an additional payday and capital for credit side for 30,000. In capital, for how much? We have it for 30,000. And the last two accounts is our revenue, consulting fee revenues is the credit side 125, and afterwards operating expenses, consulting revenue. It's a credit side for 125,000. And we also have the operating expenses. Operating expenses for the debit side. We debited for how much? We debited for 132,000 in total. And now we need to calculate the amount of total for debit and credit. So basically to sum up everything what we have for debit and credit. And as you remember, our debit has to be equal to our credit. So if we sum up all the amounts in the debit column, it gives us $35,000. And the same thing that we are doing is to sum up all amounts in the credit side. And luckily, it gives us the same amount. So it means that all our reports were correctly recorded and our accounts is equal. And now let's move to the last part of this Venkman exercise. Here we need to prepare this financial statements. We're continuing with preparation of financial statements. And always we start with the income statement. Why? Because our net income, which we'll be receiving in income statement, we need further to preparation of the statement of stakeholders' equity. So let's start. We always start with, so here I colored the system in the two colors, revenues and expenses account. So we're starting with the revenues. So revenues, for us we have the consulting fees earned. Fees earned. So, and it gives us 125,000 is how much we earned in fees. And then we have an expenses, operating expenses. So here we have really basic one, really simple type of income statements with only type of revenues and with one type of expenses. Afterwards, when the problem will become more complex and complex, you can get a different type of expenses, different type of revenues, and different type of accounts for the income statements. Now we're learning and starting with the base one. I put the 130,000 in brackets. Why? Because if I want to represent that we minus this amount, we deduct it, I always put it in brackets. So, and what we have, we see that our revenues exceed the amount of expenses, so it means that we spent more than we earned. It means that here in this case we are getting net loss. We are not earning the income. And net loss will be equal to 1,025 125,000 minus 132,000 and give us the loss of $7,000. So here is the final amount that I will include afterwards in my statement of stockholders' equity. So the net loss. Let's move to the statement of stockholders' equity, how we will prepare it. So here I already prepared the base structure of the statement of stockholders' equity. All accounts that you have to have on the horizontal line, common stock, EPIC, retained earnings, and all elements that you have in the vertical line, beginning balance, issuance of stock, net income, what gives us ending balance. And now our goal is to fill in with the correct numbers in the correct column. So what we have in the beginning balance? As we know that it's our first year of operation, first 3 months of operation, our beginning balance will equal to 0 because we have nothing left from the previous period because it's our first year of existence. So it means in this column we are putting 0. Then for issuance of stock, we know that the 3 of owners put 30,000 of shares each, so receive 30,000 of shares each, which gives us 90,000. And we also have it here, so our common stock is increased by 90,000. So we have 90,000 we are putting in common stock. And we also know that the additional paid in capital was for us 30,000. So we have it in our trial balance. Retained earnings, for now we put it 0. And we do the sum of our line of issuance stock. So in total, there is always a sum of horizontal line, and ending balance is the sum of vertical line. So here it gives us 120,000. What is the net income? We remember that net income connected to the statement of stockholders' equity through the retained earnings account. Therefore, net income we inserting exactly in the retained earnings column as 7,000 loss, minus 7,000. Once again, it's a negative amount, therefore I put it in brackets. And here I also put it in brackets because the sum of this horizontal line gives me 7,000. Ending balance. Ending balance, as you remember, is the sum of all these 3 vertical line, beginning balance, issuance of stock, and net income, what gives us 90,000. Here we have the sum of 30,000, then 7,000, and 113,000. It's the amount of here vertical line. So here it is our statement of stockholders' equity. And now let's move to the last one, the last financial statement that we'll be looking at into details. So it's a balance sheet. So for now we'll be not touching the statement of cash flow because we have not enough knowledge to prepare the full statement of the cash flow using the indirect method. So here we will be looking more into details on the balance sheet. So how our balance sheet will look like. Again, here I prepared already the base structure of the balance sheet, how it should look like. So here we're starting with the cash. Cash we have how much? We have, let's check in our trial balance, we have 133,000. We are putting it here. So afterwards we have our accounts receivable. Accounts receivable we have for 70,000. And basically it's what we have all for total current assets. So here we're talking about the total current assets. Total current assets. And it gives us the sum of these two amounts, 203,000. Afterwards, we will be dealing with the non-current assets. For non-current assets, we only have an equipment. And here we're putting equipment. Equipment we have for the amount of 40,000. and it's all our non-current assets, total non-current assets, and it's 40,000. And now we need to calculate the total assets that we have. So it's current assets plus non-current assets. It gives us 243,000. So here we filled in our asset section. Let's now look what we have in our liabilities. Liabilities, let's look again in our trial balance. It's starting with the accounts payable and long-term loan. So we have one current liability and one non-current liability. So let's fill it in. So here we have accounts payable. Accounts payable for which amount is 30,000. And it's our total current liabilities. Total current liabilities is equal to the 30,000. And what we have in non-current, as we already mentioned, it's our loan payable. Loan payable we took for 100,000, as you remember. And it gives us total non-current liabilities. Total non-current liabilities, $100,000. So, with our stockholders' equity, so common stock. For common stock, we have 90,000. Then, in stockholders' equity, we including as well our additional paid-in capital. Additional paid-in capital in our case is equal to 30,000, and retained earnings account is minus 7,000 because it's equal actually in our case to net income. We don't have any dividends paid, so it's equal to our net income. So total stakeholders equity is equal to 130,000, and it gives us in total all the elements that we calculated. Total liabilities, total stockholders equity gives us 243,000. And as we remember, our total asset has to be equal to our total liabilities and total stockholders equity. So here is how the balance sheet has to look like. So, and now I would like to suggest you to look briefly on the cash flow statement. So we will be not using the real preparation of the cash flow statement, but we would like to look at which activities we have and how we prepare from the perspective of the activities. So I would suggest you to look at from this T account of cash, what we have on debit and credit, because as you remember in the cash flow statement, we only present the transaction which includes their movement of real cash, if our cash will move or not, moved in or moved out. So therefore, before we start build the cash flow statement, let's categorize which type of cash we have, where we used it, and where we invested. So 120,000. So let's look in our trial balance what we have for 120,000. So in our case, it's issuance of stock for 120,000. So as you remember, we have it here for cash, 120,000, the first issuance of stock. So it's financing activity, everything connected to the stakeholders' equity, issuance of stock, payment of the dividends, financing of our activity. It's a financing activity because this money was used to set up the company. This money was used to pursue the operations. Then we have 100,000. As you remember, we took the loan from the bank. The loan from the bank is 100,000, so it's also financing activities. All entities that give us cash in order to pursue our business operation and to deliver the services and produce goods, it's considered to be financing activity because afterwards we will be using for our operation. So 100,000 bank loan is a financing activity. Then we have 55,000 and it's operating activity because it's an expense that we use to cover all our operating expenses. Everything what we use in the production, in delivering of service, we needed to spend it in order to earn our revenue. So this type of expenses which is presented in the income statement is considered to be operating. Then on the credit side we have $40,000 that we invested in order to buy our equipment. Here we have a golden rule to remember that whenever we invest, whenever we buy the long-term assets, equipment, cars, houses, any long-term equipment that we will be using for the next period of time, several periods of times, 1 year, 2 years, 3 years, so for a long period of time, it's an investing activity. And then we have $102,000 that we used, as you already remember, paid for our expenses. 102,000 we paid for our expenses. It's operating activities. Sorry, I hear there was 55,000. I did a mistake. I said that we used it for the expenses. Indeed, we used it for the it's our cash that we received from the earned revenue. Consulting revenue is the cash that we earn. So it's our operating expense. It's our operating activity cash because we earn this money. It's our revenue, and everything that's coming from our clients, from our revenue, is our operating activity. And now, when we categorized everything, let's briefly sum up all that we have for the cash used by operating activities, cash used by investing activities, and by the financing. As I already told you, consulting fees collected, it's our types of revenue, so it's 55,000 we represented here. Then we have operating expenses. It's equal to the 102,000. So here you remember that we represent only cash, only movement of real cash. We don't need to represent everything, the total amounts, everything what happened. We'll only represent where we used our cash, where we invested our cash. And again, all negative numbers I put here in brackets. So it's all our operating activities, cash used for the operating activities. Then we have purchase of equipment. As you remember, equipment is a long-term asset. It's represented in the investing activities. We invested 40,000, so we took money from our company. We invested it, therefore it's minus 40,000. Then the last is financing activity, and in the financing activity, as you remember, we have issuance of stock because we issued stock. We put money in to set up our company. And we issued it for 120,000. And we took the loan from the bank. It was our sort of financement, $100,000, what in total gives us $220 used by the cash provided by financing activities. So here, be careful, you need to pay attention what was used, what was provided by. So the financing activities provided us $220,000 in order to finance our operations, and then the cash was used here by operating activities and investing activities. Here we're calculating a net increase in cash. Net increase in cash is 133,000, and here we need to basically is the sum of all the elements, the cash used by operating plus cash used by investing activities and plus cash provided by financing activities, it gives us 133,000. Then we need to plus beginning balance. of cash, but as you remember, it's our first 3 months of operation, first year. We don't have any cash left from the previous period. Therefore, our ending cash balance is equal to the net increase in cash, what we calculated before. Always the beginning balance of cash we're taking from the previous period, and as soon as you see the beginning balance, it means that you need to look on your previous period, what you had before. As it's our first year of operation and we nothing had, therefore we put simply 0 there. So here we did all tasks to the Venkman problem. I am available for all of your questions that you have in the end of the chapter 2, that you have in the end of watching this video. Thank you for your attention, and we will be more looking in our tutoring session more closely into details, into all your questions, into all your concerns. Thank you.